The dollar fell to a 15-year low against the yen today. Our next guest says its weakness should boost corporate earnings and the economy. Rod Smyth is the chief investment strategist at the Riverfront Investment Group, which has $2.1 billion in assets under management. He's also the former chief investment strategist of Wachovia Securities. Welcome to Bloomberg News. Good to have you back on.
Yeah, thanks, Mark. Nice to be here.
Before we even get into this, this roller coaster ride that the dollar is on, let's get your thoughts on that. Is it traditionally what we're seeing in a macroeconomic environment, or is something else at play going on here?
Yeah, there is something else at play, and the something else at play is that the Fed is very much trying to facilitate a recovery with policy tools that are very blunt and can only impact certain things. But one of the things they can impact is the dollar. And when they talk about quantitative easing, which I know you've been talking about a lot in the last hour, when they're talking about printing money, it's not that hard to get the dollar to be weaker, and that does help. It definitely helps, and it's if you set interest rates at zero and inflation is more than zero, then the value of paper money is going down every day, and that drives people into gold, it drives people into assets.
Well, since those interest rates are at zero, where does the dollar go from here? The Fed can't make any more moves, can it?
Oh, sure, because it's all about how much they print. So it's been the promise of QE2 that has led to the next leg down in the dollar. The challenge is what can it go down against? Because the world is playing a game of let's see who can have the weakest currency, but the one group that is not willing to play in that game is the euro. And so that's why you're seeing the euro strengthening, which I think is going to have horrible repercussions for the weaker countries of southern Europe.
What might those repercussions look like?
Well, think about it. If you're where I'm from, if you're Ireland, or if you're Italy, or Spain, or Portugal, or Greece, these are countries that, if they had their own currencies, would be using the process of devaluation to try and regenerate their economies. But because France and Germany and the Bundesbank are keeping the euro strong, their problems are only getting exacerbated. So I really thought that the European Central Bank would set policy for the weakest link, but they're very clearly setting policy for Germany.
Any thoughts on Mr. Trichet's comments today about the dollar and about the currency?
He doesn't like what's happening, does he? Because he feels like he's sort of keeping his currency where it is and everybody else is devaluing against him. And so it's not surprising that he's uncomfortable, because I think he knows only too well that you start to get a $1.40, $1.50 euro, you're going to have all the problems re-emerging in the weaker countries of southern Europe.
Yeah, how are multinationals going to benefit from this dollar weakness?
Well, in the most simple sense, which is that in dollar terms, when they bring their earnings back here, they look better. Now, it's a little bit of an illusion, but we all live in terms of the dollar. If you were an Irish or a British investor in the U.S. stock market, you wouldn't have seen much in the last month, because as much as the market's gone up, the dollar's gone down. So it is a little bit of an illusion, but it feels better to us living here in the U.S.
How does this dollar weakness then make a bullish case for gold?
Well, I think gold is, again, if you think about gold not so much going up, but holding its value and everything else going down, gold is seen as a store of value. And when paper money pays you less than the rate of inflation, which is the case today in almost every country, then people want to buy gold. And gold will keep going up, in my judgment. I think it's expensive, but it will keep going up until we have interest rates higher than the rate of inflation.
You have advice for investors, and that is that they should own stocks that look like bonds. What do you mean by that?
Yeah, I think we should own stocks that look like bonds and bonds that look like stocks. So stocks that look like bonds are high-quality companies with strong balance sheets, stable businesses, less volatile share prices, and decent dividends. Bonds that look like stocks are higher yielding, more risky companies, but where you're getting the fixed rate of interest that you get from a high yield bond.
All right, Rod Smyth of the Riverfront Investment Group joining us here on set. Rod, thanks so much for coming, and appreciate it. Thank you so much.